And welcome to Money Control. You have tuned into Earnings Express and I'm your host Nickey Mirchandani. Today we're going to be talking about Yatra Online, the newly listed company which was reported in the June quarter numbers. Revenue is up by 24% year-on-year basis. Margins have studied around that 13-14%, and PAT, the company has reported profit of nearly steadied around that 6 crore kind of a figure. But how does the outlook stack up? Let's find this out from the CEO of the company, Dhruv Shringi, who will talk about the Q1 fine print and the strategy ahead. Hello there.
Hi Nickey, thank you so much for having me on your show. And let me start off by wishing all your viewers a very happy and prosperous Diwali as we come into the holiday season.
All right, thank you so much, and it's a pleasure having you with us. Let's start off with the profitability bit first. The last time we spoke at the time of your fundraising, that's the IPO interview that we did, you spoke about the modest gains perhaps, or let's just say profits that the company clocked in FY23. For the first quarter too, the number is at around 6 odd crore, which is almost similar to what we've seen in FY23. Provide us full year guidance and how can we look at the road ahead and the levers of profitability.
Sure. So if you look at firstly at an EBITDA level, right, we had about 17 plus crores in terms of EBITDA for the quarter. Year over year, interest cost is the one which has gone up, and had the interest cost remained at the same level as last year, you would have seen much higher improvement in terms of PAT. Please take into account that this quarter is still a quarter when the company was private, and so would be the case for the second quarter. The impact of the capital that we've raised in the IPO will start kicking in from the month of October onwards. So going forward, we'll see a reduction in terms of our interest outflow, and that will lead to a significant improvement in the fall through from our EBITDA to PAT. So going forward, we would expect our PAT numbers to increase meaningfully as the interest ends up coming down over the subsequent quarters.
When you say meaningfully, you reported a profit of 7.63 crore in FY23 after reporting in sharp losses in FY21 and 22 because of the COVID pandemic years. The turnaround did take place in FY23, a modest 8 crore level. In the first quarter itself, the company has clocked in 6 crore. If you were supposed to analyze that kind of profitability, do you think that's going to be a fair assessment? Some guidance that you can provide?
See, I think it's not right for me to give out guidance per se, but as you said, if you can just extrapolate on the first quarter numbers itself, that is meaningfully higher. That itself extrapolates into almost 3 times of last year, right? So you will continue to see progress, you'll continue to see strong improvement. And if you look at the underlying fundamentals of the business, there is strong macro tailwind behind domestic aviation at this point. And then more specifically around Yatra, we are seeing very strong tailwind on the new customer acquisition on the corporate front. In the first quarter itself, we had 19 new customers that we signed up, almost worth about 150 crores in terms of annual billing potential. So there is strong tailwind behind the business. And given that there is good operating leverage, there is every indication that profits should improve quarter on quarter.
So 24 crore is the number that we can extrapolate if we were supposed to just have the number into 3, right? That's the basic math that we're working with.
Right.
All right, talk about the margin profile in that case. For the quarter, the margin stood at around 15-16% odd absolute basis, not talking about adjusted basis. Could you help us understand what kind of run rate can we expect going forward? What are the levers for the operational performance? And third part, the marginal difference between corporate and B2C bookings.
Sure. So looking at the margin profile, we expect margins to also gradually continue to improve. Given that ours is a tech-enabled business, there is a high degree of operating leverage that kicks in. So with every incremental growth in revenue, you'll see margin expansion happening as well. We would expect margins, and this is something that we've been talking about in the near term, right, and the midterm, to get closer to 20%. So improve from the 15 to 16% range where we are at right now and get to the 20% mark over the course of the next 3 odd years. So the margin expansion should continue to happen as revenue continues to scale up. In terms of the mix between corporate and consumer, we are today trending close to about 55% of our gross bookings coming from B2C and about 45% coming from B2B.
What's the margin difference between the two segments, please?
See the margin, we don't call out the margin separately by channel, but yes, as you can imagine, the consumer business does tend to be more competitive. And then from a margin profile point of view, the margins of the consumer business are lower than the margin on the corporate business.
Okay, that's exactly what I was wanting to know. How much lower precisely, if you could give in that
We have to
understanding?
really stick with what the numbers are in the disclosure, given that there isn't a segment-wise disclosure that we make right now. I think it's critical for us as a business. Some of these things are our secret sauce. So we want to hold on to that till we continue to dominate this market on the corporate travel side. We want to scale up faster. We want to get to a stage where we are, by far the largest player in the country. And at that point, I think that would be the appropriate moment to start disclosing these by individual line items. But for the moment, I think it should suffice to say that the margins on the corporate side are meaningfully higher than the margins on the consumer side.
All right, not touching around with that secret sauce, but can you give us an indication at least where your market share position is today in terms of the corporate travel versus the pre-COVID COVID era that we saw? Because the last interview that we had, you pointed out the reason for slower revenue growth as compared to that of peers was this particular thing. How is that fared out now? Where are you in terms of market share? Where do you intend to be? Your assessment.
Sure. So if you look at, on the corporate travel side, in terms of new customers from pre-COVID till now, we've added almost about 120 new customers. So that's almost a 20% increase in customer base from the pre-COVID era till now. And then in terms of spend levels, right, if you can look at, the sequential growth that we have in the sequential quarter as well, our volumes grew 6%, while the industry volumes grew 3%, right? And this is much faster than our peers as well. So you will see that, because of the recovery in the corporate travel business now, we are actually growing much faster than market and much faster than peers as well.
What's the number that you've pegged, please?
So the number in terms of, our growth Q on Q was 6%, and the industry growth quarter on quarter was 3%. So double the industry growth rate.
All right, that's clearly a fair share that you're talking about. A couple of other questions that I have for you. Let's also understand about your overall new customers. Correct me here if I'm wrong, 18 million new customers. This seemed to be bigger than the traditional customer base that you've added. What explains this and what kind of run rate for this one?
So the reason, we are seeing higher revenue per customer right now is we are seeing good uptake happening in the larger part of the segment as well, in the large category. And the reason we've seen this is that over the last few years, especially the last now 18 odd months, we've seen a trend on the part of large organizations to automate their business processes. So we've looked at some of these companies which have been working with us and large, conglomerates. They've tried to bring all their different companies onto the same platform. So we are seeing benefits accruing from there, where we are getting more traction today in the larger part of the segment. So we are seeing some larger customer wins happening on account of that. In fact, as recently as yesterday, we announced the win of Wells Fund, which has gone live on our platform as well.
All right, we're going to we'll touch base on that in just a jiffy. But first, I'm going to address in the total corporate clients additions that you've been talking about in H1 and their annual revenue potential, perhaps for the year.
Sure. So we added 18 new customers in the first quarter of the year, and their gross billing potential is about 150 crores.
All right, let's get on to the segmental breakup. In that case, the air passenger perhaps grew in by 41.5% year on year. The segmental perhaps higher than that of industry standards. Your outlook for this one, and what can be expected in terms of the growth now from this segment, and will that change your revenue mix going forward?
Sure. So if you look at the air passenger industry, domestic air passenger industry, it grew about 14.8% year over year. Vis-a-vis that, we guys grew at about 42%. Our expectation will be that we will continue to outpace in the range of at least 1.5 to 2x the industry growth rate over the next few years as well. So I would expect industry to grow, in the early double digits, and we would then expect to grow at least 1.5 to 2x of the industry growth rate.
That's pretty aggressive estimate, I would call. But can you also,
So let me
what
elaborate on
justifies that? Sure, you could go on. And also in terms of the passenger fare rates, do you see that getting revised anytime soon?
Sure.
Your assessment.
Yeah, so firstly, in terms of what gives us the confidence around the growth rate is that if you were to look at our cadence in the 4-5 years pre-COVID, the market was growing at about 12, we were growing at a CAGR of 24%, right? So we were growing almost at double the market. So we expect that going forward as well, we should be able to maintain the same cadence as a company. And in terms of airfares, I think given where the oil prices are today, we've already witnessed in the month of October the fares have begun to go up rather, and we are seeing almost a mid to high single digit kind of increase across the board between September and October. Even on a year over year basis, we are seeing about a 4 to 5% increase in fares. So my estimation is that given where oil prices are, given that input cost continues to go up, we will see mid to high single digit kind of fare increase at least in this quarter. It may stabilize if oil prices come down, but if they don't, my sense is that these would be the new fare levels going forward.
Sure. Let's talk about your operating expense going forward. Do you have a meaningful amount of catch up that you need to do on the OPEX now that you have some additional cash to pay?
So on the OPEX side, I think we're pretty much sorted. There might be a little bit of incremental technology development cost which will be there, but beyond that, there isn't anything significant that we need to incur. The vast majority of the heavy lifting on that was already done in the last fiscal year.
All right. Last question then perhaps that I have for you is in terms of the M&A opportunities. The last time we spoke, you said that around 150 crore has been earmarked for acquisitions. Where are you right now with those kind of targets? Have you zeroed down something? When can we expect something material coming out of this?
So I think this is something that we are looking at quite closely, and this will take its due course and its due process. So as soon as we are in a position that we've narrowed down on something and we've made some progress on that, we'll be ready to share it with you, and maybe you'll be the first one to hear it from us.
All right, fingers crossed for this one. But Dhruv, how do you see your revenue growing forward in terms of the inorganic mix? What kind of growth are you targeting from that? Your quick assessment.
See, our assessment is, as I said, that largely it will be organic growth. We don't really put a number on the inorganic growth per se. Our endeavor would be to look at businesses which are complementary in nature. It's not necessarily that they need to have a large revenue base. They need to have maybe a great product which can be cross-sold to our large customer base, or they are a technology solution that can help streamline our own business processes and drive down cost. So it's not really just linked to a revenue that there is a particular revenue number in mind. It's more about what is the kind of incremental return that we will generate on the acquisition price. So as long as it's going to generate and we put a hurdle rate of at least 20% plus, if not 25% in terms of incremental return.
And any kind of mix that you'd want to project from organic or inorganic, or you think the number is too modest enough or small enough for you to put it in perspective?
It will be material enough to significantly change the organic versus inorganic.
All right, in that case, we're going to leave it at that. And thank you for taking out the time and speaking to us as always.
No, my pleasure, and wishing you a happy Diwali.
Wish you too. Thank you.
Thank you.
All right, with this, it's a wrap. Thank you so much for tuning in.